Thank you very much for joining us today for today's webinar, which is investing during a pandemic. Given the nature of this presentation, it'll be far less focused on the product of Sharesight and more just on some observations in these uncertain times. So perhaps there'll be less questions. But again, feel free to get in contact with us if you'd like clarification on anything. Okay, so. Investing during a pandemic. This is new to me. This is my first pandemic. I've never invested in the context of what we're going through now. I guess just to add some context on my own sort of personal situation. I'm 38 years old. As you can hear in my accent, I'm from the States originally, but I've been living in Sydney for over 10 years. So I was at university when the tech wreck happened. I remember studying that in my business and finance classes, but really it was purely academic. I had very little, if at all, any money in the market at that time. I moved to Sydney during the GFC, so I did experience that as a professional. And now here we are in 2020, which has all of a sudden become the sort of the third really dramatic downturn in the share market in my relatively short career. So just to give you a perspective on kind of where I come from on this topic. I gave this presentation last week to an investment community called Finimize. That is a global digital and in-person investment community. It is focused on newer, beginner, or younger investors. So keep that in mind as I go through some of this as well. We realized that at Sharesight, we have a full spectrum of investors, those who have just gotten started all the way up to professionals as well. So just keep that in mind as I move through these slides. So first and foremost, just an important disclaimer, and normally we kind of breeze through these, but keep in mind that Sharesight does not hold an AFSL. We are not licensed to provide any kind of financial investment or taxation advice. And so anything you see in this presentation or anything I talk to is my own opinion. So this does not constitute a product recommendation, an investment recommendation, taxation, or financial advice. We do ask that you please check with your advisor or accountant to obtain the appropriate level of advice for your situation. So please do take this disclaimer seriously. All right, so investing during a pandemic. We begin with sort of the fear cycle. And we've seen a lot of that certainly over the past 6 to 8 to 10 weeks. Unfortunately, all of us have become accustomed to looking at these charts on what seems like a daily basis, unfortunately. This is the Johns Hopkins dashboard that I find myself looking at, I guess, almost on a daily basis. This one here is data for Australia, where I'm sitting as at today. Certainly, it is good to see those numbers, at least in Australia and for our mates over in New Zealand, coming down significantly. But certainly, we're not out of the woods yet. There's a lot of concern about the numbers in the States, where a lot of my family still are. So, you know, we've been conditioned to kind of look at these scary statistics every day, and it really does drive that fear cycle. Additionally, the headlines. You know, we live in a very connected world, perhaps too connected. We've become accustomed to looking at the headlines almost on a sort of a intraday basis. You know, we've been hearing about bank dividend cuts, and we've seen those come to pass with ANZ here in Australia today. We've seen capital raisings to shore up balance sheets. We've seen a major airline go into administration. We've seen mentions of this being worse than the Great Depression. All of our, beloved sport leagues, like the NBA, in my case, being from Chicago, has been put on ice for the foreseeable future. But there's a lot of volatility too. I just grabbed that bottom right headline today. There seems to be some, I guess, guarded optimism over a new drug treatment. So we'll see where that takes us. But if you're like me, I kind of find myself really having a different appraisal of the situation almost on a daily basis, if not a sort of a morning versus an afternoon basis. And a lot of that's wrapped up too. And the effects on our families and our businesses and being, stuck inside of our homes, in my case, with a 2-year-old and a 5-year-old, which doesn't make working all that easy. If you do hear any screaming in the background, please understand that is them, just being a bit loud and rambunctious on a rainy day here in Sydney. this chart as well is certainly driving a lot of anxiety and a lot of fear in the share markets and how we might be investing. If you're looking at this chart thinking, what's the big deal? You might have missed the major takeaway, which is all the way on the right-hand side of the screen, which is that just ridiculously dramatic increase in jobless claims in the States. I pulled this data for most of this presentation last week, so keep that in mind if you're looking at some of these numbers. This is from the New York Times and the US Department of Labor. But we now have over 22 million jobless claims in the United States. And I like this chart because it does a couple of things. One, it shows you just how many more jobless claims that is than at any point in the recent history. But there is a bit of chart trickery here as well, because all the jobless claims that have happened as a result of COVID-19 have come really, really quickly. And if you were to combine or stack up the jobless claims in that recession, that gray area from 08 to 09, you might have a spike that's similar in magnitude, although I don't think it would be quite as high to what you're seeing today. But I guess this sort of leads to the question is, what the heck happens after we can finally get back to work? And I just don't have an answer to that question. I don't think any person who's more qualified than me has an answer to that question as well. If we look at our own share portfolios, we see a lot of red numbers. So this is a core portfolio that I maintain. I have changed some of the figures in here just to keep it a bit anonymous. But a lot of red numbers in there, both amongst the benchmarks we're tracking and our real holdings. I joined Sharesight 7 years ago. So really that's been a bull market more or less that entire time. So I'm really not used to seeing red numbers in our own software or those charts going sort of down and to the right. Everything we do for demonstration purposes has always shown a nice healthy return and a nice up and to the right chart, which tends to make the software look a bit better anyway. But certainly some eye-popping numbers in there depending on the time frame that you're looking at in our software. I think it is important, though, to try to apply context to this. And by that, I mean zooming out and using sort of our collective experience in markets and some of the wisdom of others and trusted sources in how we look at this. And I guess, although I am sort of on the younger side as far as investors go, I did begin my career with Morningstar in their asset allocation research division. So basically, it was my job to run long-term asset allocation models. So start with inputs today and then extrapolate those over 30 years and examine the drivers of risk and return and things like that. So I was very lucky to start my career in sort of an academic background in looking at market performance over time. I mentioned before my tenure at Sharesight. It's really important to remember that we've been on a very long bull market run, really for 10 years. And that's depicted by the right-hand chart on this particular slide. This again is S&P 500. And again, you'll note that a lot of my examples here are US based. I am based in Australia, but of course the US market can act as a convenient global proxy for what a lot of us are experiencing in our own portfolios right now. So you can see there just the size and the duration of that bull market, bested only by what's known here as the Great Expansion in kind of the 1990s up until the dot-com bubble burst in 2000, 2001. So we were riding a really good run for quite a while. And, thinking back to kind of the last 2 or maybe 3 Januaries, it would seem that as I sort of came out of my own holiday break, and I would start kind of, doing a bit of research for my own personal investing purposes. It did seem that for the last 2 or 3 Januaries, I would read something like, okay, this is the year, this is the bear market year. This is the year that, Trump's going to do X, or that China's going to do Y, or that all that money that we printed to recover from the GFC will finally come home to roost. And it kind of never happened. And what I think is really interesting is that it took an instantaneous and external and a truly global event such as this pandemic to finally send us into that bear market territory. Although we've come out of that actually recently, just over the last few trading sessions. So do keep in mind where we've come from in relation to previous bull markets. If you zoom out and you look at the price return of the ASX 200, this is a 5-year chart courtesy of our friends at Bloomberg. You can see the dramatic fall there from the market highs back in February. But as steep as that fall has been, the market has recovered a fair amount of ground in a short time. We've seen a lot of volatility in there as well. I think just before today, I checked and the ASX was up another percentage point. But we're basically trading at levels that we saw not that long ago, back in December of 2018, denoted by that red dashed line in there. So you really don't have to go back that far in time to find a place where we were at, just to add some context to where we're at locally. Now, how does this current downturn compare to other global sustained downturns? This chart's a bit busy, so I'll do my best to kind of verbally step you through it. This is courtesy of Ibbotson Associates and our friends at Morningstar. What they've done here in this chart is they've normalized the portfolio amounts, or they've sort of the portfolio invested amounts, and that's over there on the left-hand side toward the top at zero. They've adjusted for inflation and all the rest. And so you can see there that the real wealth losses for 6 different events going back to the early 1900s, and by far the worst was the 1929 share market crash and the ensuing Great Depression. In which case, if you invested $100, you would have lost 79 of them, right? So that was a very, very severe market downturn. I was surprised when I looked at this chart to note that the second worst crash, if we can call it that in history, is what they're calling here the lost decade, from, I guess, the end of the tech wreck, the start of the tech wreck through the GFC into May of 2013, which is interestingly right when I joined Sharesight, as a matter of fact. So the market there down 54% at its worst. The 1918 flu is the third worst, which is obviously relevant to what we're going through today. But you can see there at the far left-hand side, that number highlighted in the red box, minus 22.5%. Those are the falls we have seen from COVID-19 through the 31st of March. So keep that in mind too when you're looking at this data. So how long will this last, and what kind of recovery and what the stock market will do? There's a lot of room to run to the right, but it is important to keep in mind that this market performance thus far has not been nearly as bad as some of the other sort of market collapses that we've seen. And I love this chart. This is perhaps my favorite, again, staying with our friends from Ibbotson and from Morningstar. This is a hypothetical investment of $1 invested in the share market in 1870, if we could all be so lucky to invest with that kind of time horizon. And this shows the growth of that $1 invested, along with global events along the way, and market downturns, or market crashes, as they call it here, in the red shaded areas. And so if you invested $1 way back in 1870 and rolled that forward until just before COVID-19, that would have been worth just over 19,000 US dollars, right? Taking into account the downturn from the pandemic, that would have fallen to $15,303. So certainly a significant downturn. But if you zoom out and you compare the downturn there to the lost decade, which we just spoke to Black Monday in 1987, to the 1929 crash, and a few other ones listed there, it barely even registers, at least from a visual standpoint, on this chart. I was struck in particular by Black Monday, which, I had sort of been told stories about as a 7-year-old, from my father, who was involved in the markets, and just how big of a deal that was. In fact, I think he still has the Wall Street Journal cover page from that day. But you can see there that, compared to other market downturns, that was not as significant, right? So this chart does give me some optimism and reinforces one of my favorite sort of investing principles, which is it's about time in the market, over and above anything else. I pulled this chart just this morning, actually, from The Economist. So the information's a bit raw, so you'll forgive me if I bumble over it a bit. I thought this was really interesting. This is exposure to COVID-19 and market performance. And this is an academic white paper that's still a work in progress, I believe. But what they're comparing here on the vertical axis is average weekly stock market returns from January through the end of March, versus the horizontal axis, which is the growth rates of confirmed COVID-19 cases. The blue dashed line, I guess, is the trend line there, and the red line horizontally is a 0% return in the share market. Some really interesting things, I guess, stood out at me. I guess, interesting to see New Zealand and our mates there doing quite well in relative terms, in terms of the stock market return. But then I actually went into the white paper and I listed all of the dots, the countries that are actually above that 0% performance line. And it's not the best list of countries, at least from a shareholder protection and sort of traditional shareholder stewardship cohort. Kuwait, Cyprus, Oman, Poland, Russia, and so on and so forth. So I thought that was quite interesting because, it's showing that, COVID-19 is not having the same, at least share market impact on a global basis, nor is it having the same, industry sector and particular company impact as well. And if you read this paper, it's linked inside of the Economist article. You can just Google that and find it. It's really interesting. It does show that sort of your blue chip companies with healthy cash laden balance sheets are doing quite well. No surprise there. Also, some other interesting things too, where if you look at the cap tables of these companies that are trading in these particular countries that are above water, it would seem that lower exposures to hedge fund ownership is also a good thing in terms of how these companies and their countries have performed as well. It could also be here too, just kind of looking at my list of countries there. It could be that these particular share markets are small and therefore dominated by one or two blue chip companies, and therefore the entire performance of that country has done well as a result. But I thought this was quite interesting. Again, just today from The Economist and an academic white paper sourced there at the bottom of the chart. I had a look at my own portfolio. Again, these are all real holdings that I do own, but the amounts have been changed to protect the innocent. I just stack rank these using the performance report, and I'm not grouping by anything. And I'm looking at percentage return here. It was really interesting, I guess, commentary in this data on COVID-19 in general. I like the iShares Global Health ETF, trades on the ASX. I've long held that ETF for several reasons. You can see that's doing quite well as a result of the pandemic. Followed by the Wide Moat ETF. That's from my Morningstar research background on wide moat companies. S&P 500's done quite well. I've been keeping a keen eye on my Chinese exposure. So Tencent and Alibaba, those companies have done quite well as well. But you can also see there in the currency column that I've been hit pretty hard because I'm investing, in U.S. companies or companies that at least trade in the U.S. with my Aussie dollars. So that's been holding me back quite a bit as well. And then again, if you look at the bottom of this table, you can see, CBAs and the Westpacs certainly been hit hard, and Auckland International Airport, which has been hit really hard as well. So it'd be really interesting to see what this does to the tourism situation in New Zealand and their economy as a whole. So anyway, I just kind of wanted to share some of the companies that I'm currently invested in myself and how they've been impacted by COVID-19. So we've talked about the fear. We've tried to add a bit of context, and I guess just looking forward to opportunity. I guess this is really finally what value investors, at least traditional value investors, have been waiting for. Value investors haven't had a lot to do or to invest in over the past sort of 5 years or so. But again, if we draw on research from our mates at Morningstar, you can see here that their analyst coverage set, at least for North America, is predominantly undervalued. I'm sorry for the resolution in this chart, but the important takeaway are the colors. So the blue and the green are strong buy and buy stocks, that's how their research works. Their analyst assesses a fair value for a company. And if the trading price of that company falls to a degree below that fair value, then the company becomes strong buy, fairly valued, overvalued, and so forth. So just graphically, seeing the amount of companies that are not only green and blue, but also yellow, fairly valued, is a promising sign for those of us who like to find quality companies and invest for the long term. Like our friend Warren Buffett there, who is happily eating his Dairy Queen ice cream. I've been kind of keeping an eye on for headlines for Warren or for Berkshire Hathaway, because these tend to be the opportunities where he can really put that balance sheet of Berkshire Hathaway's to work. You know, they're so big and they've got so much cash. And he's always so transparent in his annual reports, talking to, you know, their opportunities are limited by the size of Berkshire. And so they're sort of forced to buy railroads and other sort of statewide enterprises. But anyway, I've been keeping my eyes and ears open for Berkshire and what they might do. Speaking to Berkshire, I guess, and Warren's favorite sort of investing axiom, which is buying when others are greedy or the inverse when others are fearful. I wanted to go back and look at sort of a hypothetical investment using Sharesight here. And if you remember, in the depths of the GFC, there were real question marks around whether or not Goldman Sachs would survive. They did end up getting a government bailout and sort of the darkest hours of the GFC. And so if you were sort of buying into the market as others were, and as things were stabilizing at that time, this being October of 2009, you know, so still kind of coming out of the wreckage of what was happening there. And you bought Goldman Sachs, like Warren Buffett had bought Goldman Sachs, you would have achieved a 1% annualized return from that point rolling forward until today. And you can see the difference there between your return from Goldman compared to the S&P 500, which delivered about 20% per annum returns. Again, these are annualized returns going back about 10 or 11 years. And it should be said there that, you know, the S&P 500 might not be the best benchmark in this case, honestly, because over the course of that decade, it did become dominated by various tech companies, and Goldman's certainly a bank, but an interesting comparison nonetheless. Now, if you had taken Warren's advice and bought when others were truly scared, when things were at their bleakest, and indeed Berkshire Hathaway bought up, I think it was 5% of Goldman with some nice government assistance, right, in that sort of darkest hour of the GFC, and that was October of 2008. You would have achieved a 13% annualized return, which is just, you know, a huge difference, of course, than 1% annualized over the relatively same time period. But again, just the impact of timing, you know, not timing it sort of just hyper accurately, but timing it generally well. And again, using kind of time in the market as your friend can truly present a different outcome, even in the same hypothetical investment in one company here. We report on a monthly basis, if not actually more frequently these days, for ASX, NZX, and various global share market trading patterns that we see amongst our user base. This is all done anonymously, I might add. And we've been really interested to see what's been happening across our user base of about 130,000 investors. And this is for the ASX. What stands out to me here is that, you know, there's more orange on this chart than there is black. So that indicates that there is more preference for buying shares right now than there is selling, which is quite interesting. You can see there a preference for, you know, quality companies. You've got CBA, you've got Macquarie, NAB, Westpac. Interesting to see the buying there at Webjet, which tells me that people do assume that things are going to get back to normal at some point and people will be traveling again. But what stands out as well is that the top traded position, or excuse me, the top traded, not company in this case, but top traded ETF, top traded security, is a bear market ETF, Beta Shares, Australian bear market ETF. You can see there it's split roughly between buyers and sellers as well. So it's the most heavily traded instrument amongst the Australian users on our user base, but also it's split between buyers and sellers. And keep in mind that a bear market ETF is designed to short the market, right? So you're going to buy a bear market ETF when you think that the performance of the index, in this case, will go down. So very, very interesting to see. And what you can't see in this chart, which I don't have access to right now, is sort of the duration of those holdings as well. So was this real short-term trading done tactically, or are these kind of positions people are putting on as they do think that the market is going to, you know, to continue to go down? And I suppose the counterpoint to that is that stocks do remain historically expensive. So This was done by FactSet and Macquarie Research. This has been out there. This is the forward-looking, 12-month forward-looking PEs of the ASX 200, which is more than one standard deviation above average. So if you look all the way to the right-hand side of that chart, you can see how that last dot point there compares to really where we were in the GFC, which was way down at the 9.0 range. So stocks are still expensive. And again, that's probably because of that run up in stocks we've had really for that 10-year period until the outbreak of COVID-19. Also, and this is something that really kind of caught my eye, all the companies on the ASX that are withdrawing their guidance, and this is done by industry. Again, this is research done by Macquarie and shown vis-a-vis FactSet. You can see that that real estate and materials companies and consumer services are certainly the companies showing that they're most withdrawing their guidance. But 37% of companies, the biggest 100 Australian listed companies, have withdrawn their earnings guidance. So something to watch out for, as well as we're now in earnings season. And I just pulled this again this morning from our friends at Cufflinks. This was done by Nick Griffin, data from Cufflinks and from Bloomberg. They're tracking the share market performance post the outbreak of COVID-19. They've overlaid that on the share market performance on the same sort of duration of days against the GFC. So you can see that actually the tracking is quite highly correlated. Given where we are now versus where things were in the GFC. And I think the question is this, it'll go to the right, we know that, but is it going to continue going sideways? Are we in for more falls? And are we in for kind of that V-shaped recovery? And I think that's truly the question that's sticking with me, which is, you put that many people out of work and shut down that many businesses that quickly. What happens? What happens when we can reopen? What happens when we can reopen Australia and New Zealand, maybe in unison, but we can't, travel or open up our supply chains to the States? I am certainly underqualified to answer that question. And I think that's what we're all waiting for more clarity on now. But I thought this was a particularly interesting chart that I just saw today. So again, I talking to kind of the Finimize community and sort of investors who are now just getting into the market or sort of younger investors. As I've said before, your action plan right now will depend really on your risk tolerance. Are you prepared to lose more money in the short to medium term, and your overall time horizon? So time in market is again, such a powerful factor that investors often overlook when they are investing. Be prepared, be well researched. Read those annual reports. Track those companies that you like and be prepared to put cash into them when you're ready. And I'd also say don't stress about picking the bottom precisely. I used that Goldman Sachs example before, but as long as you're sort of buying a quality company at a discount, you should expect a good return over the longer term. And again, just on kind of that time horizon and sort of being in the market. This is again from our friends at Ibbotson, and which is now owned by Morningstar. They always do these really nice long-term charts and comparisons to kind of help us with these visuals. Asset allocation is said to explain about 75% of your long-term return. That word "explain" is pretty fraught. There's been some analysis to the contrary on this, and back and forth, and this is a hotly debated topic amongst sort of the financial academic community. But over time, you cannot deny that having your money allocated towards risk assets, i.e. equities, or listed ETFs that track equities, or managed funds or mutual funds that own equities, is going to deliver outsized returns over the long term. There will be more volatility. There's more short-term risk, but this chart I think does a really nice job at explaining really the difference between having your money to work for you in the share market over the long term versus sort of corporate debt here, which is municipal bonds, which is kind of like a form of government bonds, or T-bills, which in this case are actually negative given the impacts of inflation. So just a really powerful chart there around sort of getting your money into the market to let it work for you over the long term. And then again, just kind of heading towards the finish line here. My rules for picking stocks: I like company familiarity. So I like to think about, do I use that product? Would I work at that company? That's always the lens I'm thinking about when I invest in a stock. I do take a long-term time frame. Again, I'm lucky because of my age. I can do that. I love reading annual reports. I always begin with the Berkshire Hathaway annual report. If anyone out there is just new to the share market and hasn't gone to the Berkshire website and downloaded their annual report, please do so. Even go back and you can download the old ones. Buffett is a wonderful writer, and he's got just such a knack for turning really complex things into simple jargon, really that kind of Midwestern jargon that those of us from that part of the country like myself can appreciate. IPOs, there's always a lot of news coverage about IPOs. There's a lot of excitement around IPOs. Just understand why the company is listing. The IPO these days has really taken on a different meaning, given that tech companies can stay private for so long. So just think about what that IPO means for that company and where it is on their respective journey. Don't obsess over price. If you're going to think long term and you want to buy a quality company, if you can grab a discount now, given what's going on in the markets, my personal opinion would be to go for it. Oh, and again, I avoid derivatives. Again, if you're a professional, you're a seasoned investor, of course, you can make your own decisions here. But some of those derivatives, especially some of those derivative ETFs, they do carry a premium in terms of their fees. So just watch out for those. And sometimes they can be designed for intraday usage or really that day trader sort of application. So just read the PDS and just be careful with those derivatives. We know from talking to our mates at brokers, we know from seeing some of the advertising rates that are out there in our space that derivative trading right now has just gone through the roof with things like options and CFDs and things like that, given the volatility. But just read the PDS on those would be my encouragement there. And then finally, just a couple of sort of pro tips on using Sharesight right now. Set up custom groups. Custom groups are a great way to classify the investments in your portfolio according to your own worldview, right? So these are things that make sense to you. So I do my own kind of tech lens, right? So it's kind of like, I think of this as blue chip or bedrock tech. I think of this as sort of speculative tech companies. Maybe I've got a Chinese tech bucket, or even SaaS tech as well, which is software as a service. That'll really help you personalize the information that you're seeing on Sharesight and make it meaningful to you so you can action it. Run performance reports with an ungrouped view. I always like to do that. That's what I showed earlier in the presentation when I just did a quick stack rank of all of my positions to understand kind of how COVID-19 was impacting my performance. So just take off all the groupings and then you can just do stack ranks by clicking the column headers. Look at the contribution analysis report as well. This will show you from a dollar perspective the impact or detraction on your sort of active portfolio management selections. That's a wonderful report. And then keep an eye on future income report as well. So we get information from the ASX, the NZX, and all the global share markets on upcoming dividends. And so if you are sort of a blue chip investor who is relying on yield, perhaps you're moving towards or into retirement and you're really relying on that dividend yield to fund your lifestyle, do keep an eye on that future income report as well, because if there are cuts to dividends, those will come through in that information in our report section. And then the last thing I was just going to do, I'm just going to share my Sharesight with everybody really quickly. There was an article in Forbes that I couldn't resist sort of actioning, which was basically the coronavirus economy portfolio, right? So they kind of ran a fun article, a semi-serious article too, on how to invest to take advantage of the fact that we're all stuck at home, the fact that this sort of global health emergency is affecting the way we live and work, and it's sort of benefiting some sectors and really harming others. And so I built this portfolio in Sharesight, and you can do this too. If you've got an additional portfolio slot, depending on the plan you're on, you can always create a watch list portfolio and track it. I find this is a really useful thing to do. My family and I, we bought a house last year, and so I built an Australian housing portfolio, for example, just to see if I could potentially snag any kind of discount on Sydney real estate when we bought our first family home. So in this case, I've had a bit of fun, and I just wanted to build this portfolio here based on the Forbes recommendations, which the journalist sourced from various places. So right at the top here, what I did is I bought one share of every company. So it's not equally weighted in terms of dollar. I just wanted to throw this together quickly. But you can see that our coronavirus economy portfolio has done quite well since the first purchase, which was set to be the 16th of March, right kind of in that real deep trough of global share market performance charts. So 31.5%, which is quite strong. I've denominated this portfolio in US dollars, by the way, because these are mostly US companies. Really no impact from dividends. So it's all been capital appreciation since that time. Compared to, in this case, the S&P 500, an ETF that tracks that particular index, which has done over 9% in its own right. Keep in mind here, these are total returns because we're looking at a time period that's well and truly less than a year. So these are straight total returns. But I've ungrouped all of my positions here, and I just wanted to have a quick look as to what did well and what hasn't. And what I'll do, I'll just you can stack rank these. So just ungroup these and then just rank them. And you can see that Slack, a platform that we use at Sharesight, has done exceptionally well in the face of COVID-19. Teladoc Health Systems, it's a healthcare company. Peloton, they make those at-home sort of exercise bikes that you pay quite a hefty fee to purchase, and you need to subscribe to a community of fellow Pelotoners. They've done quite well. Amazon, Netflix, no surprise there. Zoom, no surprise there, although they've been battered about recently because of Facebook and Google are aggressively trying to take market share back from them. Computer gaming companies like Electronic Arts, Activision Blizzard, J&J, Alibaba, all the way down. And then some of the ones that really haven't moved much are some of these, what I would consider a little bit more boring companies, AT&T, Campbell Soup, Clorox, and P&G. So anyway, I just wanted to put this portfolio together to demonstrate that, a lot of these companies that we're seeing out there in the news media and in popular culture have actually done quite well. So anyway, I just wanted to close on that. And with that, I might just go back to my slide deck and just go back to the top here. And look, I just wanted to also say thank you so much for joining us. We realize that all of us have been affected at the very least by what's been going on. We've been running this webinar series for a few weeks now, and the turnout and the signups and those of you joining us, the numbers have just been really, really fantastic. And really, it means so much to us that you're willing to spend, 30 minutes to an hour with us every week. So thank you so much. And we're going to continue this webinar series as well. And we do genuinely wish you all the best, not only in your portfolios, but also in your health as well. So with that, I might just flick over to the questions and try to answer any of these just to see here. Now keep in mind, before I answer these questions, I'm not going to answer any questions around specific investment advice. I'm not qualified to provide advice, and I don't want to comment on your own situation. I just think it's always important that you do seek out professional investment or accounting advice when making investment decisions. So somebody here says, is it possible to have the charts after the webinar? Yeah, we could probably put this on SlideShare or one of those platforms to allow this, to allow the sharing of there. I think I've cited and sourced all of these. I'll go back and I'll double check that. But yes, we can make that available, definitely. Someone else is asking for the slides. Yes, copy, yep. Someone is asking if price is not as important in long-term investing, what rough rules of thumb do you use to know if something is discounted? Good question. So I do two things really in broad strokes. I zoom way out on a charting service and I look at the price of the chart. I don't care what the price is, but I want to understand in relative terms, like on a 10-year basis, what has the share price done, right? And then what I do is I seek out independent research. Again, I'm biased in this case because I worked at Morningstar for 10 years. We have a professional relationship with Morningstar as well. I should mention that. But they do some truly independent research, and they will tell you what they think the fair value of that company is, which is influenced by both their own objective analysis and their subjective analysis, sort of opinionated researches as well. So I would say gather the facts and then look for a trusted opinion. But there's more out there than just Morningstar. The guys at Motley Fool do a really good job as well. There's a heap of newsletters out there to help you with as well. Someone else is asking, how did you make your housing market index? Yeah, so I basically went through and I did my own sort of Saturday afternoon project to try to understand which Australian companies were most exposed to the Aussie housing market. So those would be your banks to some degree. Those would be definitely your non-bank lenders. Those would be your building companies. Those would be your housing sort of retailers like Beacon Lighting and things like that. So it's an index of like, I don't know, 20 to 25 companies that I sort of cobbled together as best as I could, but in a kind of a non-academic way. And I should note now, I won't do it now, but it was falling significantly before the pandemic did take hold. Okay. Let's keep going through these. New Zealand index is in the positive area of that comparative chart because dominated by A2 milk and Fisher and Paykel. Yeah, that's a great point. So there are 50 some odd stocks listed on the NZX. And if you have companies like A2 milk, Fisher and Paykel, formerly Zero, those companies from a market cap standpoint will really sway what that index does, which again, as I mentioned, probably is what's going on in those other sort of random share market countries like Cyprus or UAE as well. Yeah, this is a really interesting point here. The first quarter US GDP results came out last night with a contraction of 4.8%. Yeah, that was terrifying, much more than expected. The US market went up about 1%. This only goes until the end of March. Is the market generally shamefully optimistic or irrational, or is it just me? I don't know, Stephen. The dislocation between what we're seeing in the share markets and the interest that we see in Sharesight and the engagement we see with our investing community, it does not mirror what's going on in the economy as a whole. And I should have probably mentioned that during the presentation. They're totally dislocated, and perhaps that speaks to wealth disparity. Perhaps that speaks to those of us who are in the share market and who have sort of taken hold of our investments I don't know, we're in a position where we can sort of action on it. But it's a very, very good point. And I just don't know, I just don't know what happens, as we sort of try to reactivate the economy. And some of these really eye-popping numbers like the jobless claim or these GDP numbers, I don't know how quickly those revert back the other direction and what that kind of volatility means. I'm not an economist. Maybe I'm sort of happy I'm not, but I'm not. Okay. General view of buying low-cost ETFs. I'm all for it. So I take a core satellite approach to investing. So if you look at sort of my super, my 401k, and kind of how I've allocated my assets, I go core. So I go kind of core broad market ETFs, be they the S&P 500, be they the ASX 200, be they the world market, kind of the global stock market ETFs. There's another rule I picked up in my tenure at Morningstar, which is the only guaranteed outcome in investing are the fees you pay to invest, because that will happen no matter what is going on. So low fee ETFs are absolutely wonderful for this, especially if you're just getting started in investing. So I use those as kind of the foundational pillars of my portfolio. And then I tend to make sort of tactical, riskier plays above and beyond that. But if you would have noticed in my presentation that my two best performing investments are that healthcare ETF and the S&P 500 ETF. So, so there you go. Question here. Do you think that capital raises are a good sign of the future of a company or a bad indication? That is a great question, Michael. I don't know. I think we were actually going to undertake, a colleague of mine said he was going to undertake a quick research assignment inside of Sharesight to go back and to map when capital raisings occurred from large established companies and to track the performance thereafter. So I can take that feedback back to him, and I could ask that we do that, because I'm curious to know that as well. I guess I think I saw this in the Fin recently as well. The ASX, I think, leads the world in the amount of cap raisings, additional cap raisings that it does. I don't know if that was in their how many they are from a numerical standpoint or in the valuation, probably the numerical, but certainly we're seeing a lot of these at the moment with NAB announcing one just this week. So, we'll look to that. I mean, maybe it's a situation like dividend reinvesting, right? Maybe it's like you want to keep an eye on that dividend reinvestment price. And if you think you can do better, you can wait for a bit more of a discount, keep the cash yourself and go back in when it suits you. Maybe that's what we're looking at with some of these capital raisings and the prices that these companies opt to do it at. All right. Keeping on here. More questions. I'm just having to admit there's quite a few questions in here that are just sort of specific in nature, and I will avoid those as I mentioned here. Someone here is asking, he's looking to develop his own method of valuing companies based on a combination of fundamental and technical analysis. Biggest drawback, I guess. Well, the biggest drawback is, I mean, what kind of experience do you have, sort of academically and with money in the market at doing so? So without knowing your own situation, I'm not sure. I guess I would also comment there that I've never really been a technical kind of analysis person. I like to invest in things that I know in businesses or macro themes that I'm comfortable with. So, I tend toward the more traditional sort of value long-term approach. And again, I don't know. I mean, access to information and the ability to synthesize information is something, and the time it takes is something to not overlook as well. Again, drawing on my experience in my decade at Morningstar, I mean, my job there was actually to help commercialize their equity and credit research, and they have hundreds of analysts, and they have access to every amount of raw data feed and all kinds of kind of worker bees and analysts running around there sort of synthesizing and processing this data. So that's a pretty Herculean effort in terms of cost and time. So, just those would be my kind of my knee-jerk reactions developing around analysis. Okay, so I think that'll just about do it for the questions, everybody. Look, again, I wanted to say thank you so much for taking the time to join us today. We know that, again, all of our lives have been disrupted at the very least, and we wish you all the best, not only for your portfolios, but also for your health at Sharesight. So again, if you want to reach out to us, please go to the Help tab within Sharesight. You can post on our community forum, which is very active. You can ask a question of our support team directly, and we'll get back to you there. And again, we will find a way to make these slides available. I'll work with my staff on that. We'll find a way to broadcast that as well. So thank you very much again. I hope everyone has a wonderful day.